Welcome back to our monthly real estate market update at Pries Capital Real Estate. I'm Jason Pries, the founder of Pries Capital Investment Research. Imagine for a moment that the market wasn't still feeling the aftershocks of the tariffs. If that were the case, the headline story this year would be how the housing market is outperforming expectations, even with elevated mortgage rates. We're continuing to see strength in the data. Mortgage purchase applications rose 9% week over week and are up 10% year over year, all while rates have stayed consistently above 6.64% for most of the year. Last week, financial markets reminded us just how quickly things can change. The 10-year Treasury yield jumped, sending mortgage rates higher again. But did that spike put the brakes on housing momentum? So far in 2025, we've had a solid run. Purchase application volume has been growing. Pending home sales contracts have seen month-over-month increases. But now we're watching closely. Did this latest move in mortgage rates finally break the streak? So where do we stand today? Let's dig into the latest numbers and see what's really happening in the Myrtle Beach housing market as we begin April 2025. The latest weekly pending contract data from Pries Capital Investment Research is giving us some important insight into where buyer demand stands in the Myrtle Beach housing market right now. Normally, we need to see mortgage rates trend closer to 6% before any real growth in housing demand starts to show up in the numbers. But recently, we've noticed a bit of an uptick in weekly sales activity. However, when we look at the total pending sales year over year, the data still isn't where we'd like it to be. Pending contracts are down 10.5% from this time last year. Let's break it down by year to give you some perspective. Pending sales, same week comparison. 2023, 820 contracts. 2024, 704 contracts. 2025, 630 contracts. So even with some positive movement in weekly buyer activity, the overall pending contract count shows we're still behind pace. This tells us that, while buyers are showing interest, the higher rate environment is still holding many back. We'll be watching closely to see if demand continues to build as we head deeper into the spring season, or if this recent activity was just a blip. As part of my 2025 market forecast, I've been expecting the following ranges. Mortgage rates, between 6.0% and 7.25%. 10-year Treasury yield, between 3.7% and 4.9%. In a recent article, I pointed out that without the pressure of the tariffs, we likely would have seen the 10-year yield drop below 4%. But instead, here's what actually happened. Last Sunday night, I mentioned that even a single statement out of the White House could trigger a sharp spike in yields. And sure enough, by Thursday and Friday, we witnessed stress selling in the bond market, which pushed yields sharply higher, toward that 4.35% level I had warned about. This sudden move seems to have caught even the White House off guard, as they were anticipating lower yields, not higher ones. This past week has been especially tough for mortgage rates. The spike in yields has translated into more volatility, which is creating challenges for both consumers and professionals in the real estate industry. As a result, I wouldn't be surprised if we see a decline in purchase applications next week, simply due to the instability in the rate environment. Our hope is that the situation settles down soon, allowing the market to return to a more predictable rhythm, because volatility is the enemy of confidence for both buyers and sellers. Spring is here. And I've got to say, I'm genuinely excited about the story that's unfolding in the housing market. Why? Because we're finally seeing a sustained trend of inventory growth, and that's a big deal. While we're not back to pre-pandemic normal levels yet, the market is clearly moving in a healthier direction. This is no longer the savagely unhealthy market we were stuck in during the pandemic years. Instead, we've had another solid week of inventory gains. This week's inventory numbers, April 4th to April 11th. Inventory rose from 951 to 963 active single-family listings. Year-over-year same-week inventory numbers, April 2024 to April 2025. Inventory went from 709 to 963. That's a remarkable year-over-year gain and a clear sign of market normalization. Let's put that in even broader perspective. The all-time low for inventory was back in 2022 at just 302 homes. The peak for 2024 inventory was 947 homes. So we've already surpassed that. And in 2019, the last normal year before the pandemic, active listings for this same week totaled 1,217 homes. So no, we're not quite at pre-pandemic levels yet, but we're headed in the right direction. And that's encouraging news for buyers, sellers, and the entire real estate industry. Let's talk about one of the bright spots in the 2025 housing market, new listings. Last year, I projected that during the peak seasonal months, we'd need to see at least 90 new listings per week to support a more balanced market. So far this year, I'm just 18 listings shy of that target, with plenty of time left in the season to hit, or even exceed, that number. That's a great sign that seller participation is improving, and it's exactly the kind of shift we've been waiting for. Right now, 70 to 80% of market activity is being driven by active buyers and sellers, and this increase in listings is a strong step toward a healthier, more balanced housing market. To put things in perspective, during the housing bubble crash, we were seeing 300 to 325 new listings per week, and that lasted for several years. That was an oversupply problem. What we're seeing now is a measured return to normal. Ideally, we'd like to see seasonal peaks of 110 to 130 new listings per week, and we're heading in that direction. New listings by year, same week comparison. 2023, 87 new listings. 2024, 67 new listings. 2025, 72 new listings. This year's numbers are up from last year, and even though we're not yet at pre-pandemic norms, the upward trend is clear. The story here is continued progress, and that's a welcome change from the listing drought we've experienced in recent years. In a typical year, about 1/3 of all homes on the market go through at least one price reduction, a natural part of how supply, demand, and buyer psychology all interact. But this year, as inventory continues to rise and mortgage rates remain relatively high, we're seeing a higher than normal share of homes experiencing price cuts. That's not surprising. It reflects a market that's evolving and adjusting to current conditions. However, over the past month, we've actually seen some stabilization in this trend line, which tells us the market may be finding its footing, at least temporarily. Now that rates have ticked higher again, we'll be watching to see whether this plateau in price cuts holds, or whether the elevated rate environment pushes more sellers to adjust their expectations. Looking ahead, I'm projecting a modest increase in home prices, about 1.77% for the year. Now, that would mark another year of negative real home price growth, especially when you factor in inflation. And unless we see a significant drop in mortgage rates, closer to 6%, this trajectory is likely to hold. Just for reference, I had forecasted 2.5% appreciation in 2024, which turned out to be a bit low due to a surprise dip in rates that boosted demand late in the year. Here are the price cut trends, same week comparison. 2023, 39.8% of homes with price reductions. 2024, 38.8%. And 2025, 44.4%. So far, 2025 has the highest share of price cuts, which reinforces my belief that this year's growth will be limited and conservatively paced. As for the week ahead, well, the markets are still unsettled, and until we get more clarity, economic data is taking a backseat. Even though both CPI and PPI inflation came in lower than expected, the market's reaction has been minimal. What's on the radar this week? A wave of speeches from Fed presidents, speculation on whether President Trump could replace Fed Chair Jerome Powell, key reports on retail sales and housing starts, and news over the weekend about exemptions on major tech imports from China. So yes, the news cycle is heating up, and we'll be watching it closely to see how it all plays into the housing market in the weeks ahead. And that's all the data we have time for today. Thanks for watching, and if you're looking to make sense of this ever-changing real estate market, we're here to help. Call us or visit our prestigious office at Pries Capital in Myrtle Beach, South Carolina, where we'll guide you through everything you need to know about the housing market. You can also visit our website at priescapitalrealestate.com, where you can now sign up for a free Pries Capital Real Estate research account. With this account, you'll gain access to weekly local market data. And again, I can't stress enough that this live data comes out weekly with insights tailored to your area. Whether you're buying, selling, or advising, we'll help you dive into your local market and make informed decisions. Click the link below to get started. Thanks again for tuning in, and we'll see you next time.